Experience is making mistakes and learning from them. So that's what I learned. I went to business school to learn how to be a good investor. And I learned the first rule of investing, which is you do your due diligence before you wire in your money. And when I got to HBS, I actually opened the course catalog for the first time, and there wasn't a class on investing. Now, there were classes on accounting, there were classes on finance. So I decided I had to develop my own little self-study program. And I wanted to, so I opened a Fidelity brokerage account. And I said I had some money I'd made in the real estate brokerage business. This was my tuition in the investment business. And it was about a year of tuition. And if I lost it, it was as if I had gone to business school for 2 years, but paid for 3. So I figured it's like the inverse of the Oxford 1+1 program. But, the first stock I bought went up. And then I said, okay, I found what I want to do. The answer is I was an entrepreneur, and I felt that I wanted to approach investing my own way as opposed to learn from someone else. And it's one of the few things you can really learn on your own. You can learn investing by reading books, by reading annual reports, by you can have a portfolio and invest $100, and you can learn the business, unlike many other businesses which require a lot more. At least that's what I thought at the time. As a general rule, if we conclude that we're wrong or we've learned investing is about the best investments are the ones where we are confident we're right and everyone else is wrong. Okay, and you have to, in order to be, I've been accused recently of being arrogant, among other things.
No, I'm going to actually ask you that. It was pompous, but that's okay.
Pompous? I don't think I'm pompous, but I've certainly been accused of being arrogant. And there's a difference between arrogance and confidence.
Yeah.
If you're arrogant in investing, you're going to get killed, right? If you're not confident, you'll never make an investment, right? So you have to do a sufficient amount of work to be confident enough to have the conviction to do something that's contrarian, right? We bought the stock of a soon-to-be bankrupt a shopping mall company during the financial crisis at pennies per share. You have to be willing to look silly when you do something like that. General Growth stock's up 90-fold since our original investment. We had confidence. Maybe people thought it was arrogant to believe that we could be successful in turning it around. But you also have to be humble. And you have to recognize when there are new facts you hadn't considered that are inconsistent with your thesis. Well, if you look at Herbalife, none of the bull case for Herbalife, none of those arguments have, in our view, any merit. Mm-hmm. And therefore, we continue to have conviction. But if we were to learn a new fact, that all of a sudden we realized Herbalife was a great company and it wasn't a pyramid scheme and the products really had tremendous efficacy and they were priced correctly and there was real demand for them, we would change our mind. So I think the best thing, in the investing business, you can learn by reading. Read everything Warren Buffett's ever written, watch every YouTube video he's ever appeared in. That's a great way to learn about investing. But investing is more than just, the way to really understand investing is to understand a business. And one of the most important skills you need as an investor is distinguishing between a great business, a good business, a fair business, and a bad business. And one way to get a sense of the quality of a business is go to work for one. So the recommendation I give to people graduating from business schools these days is this is the greatest time in history to work for a startup. There are lots of incredibly interesting businesses being formed. And if you can be one of the early employees, you're going to learn a lot about how a business works, how to make payroll, how to market your product, how to design something. And those skills, I think, are invaluable. First of all, you might even find it really interesting. You might have joined the next Facebook, so that's one thing. Even if the business fails, you'll learn a ton from that. I think that's the best experience you can get, ultimately, to be a good fundamental investor. In terms of the future of fundamental investing, I don't think everyone can be a passive investor, and I don't think everyone can be a quantitative trader. And I think there will be always room for fundamental value investing because fundamentally stocks are driven and business value is driven by business fundamentals, not supply and demand for securities in the short term, not the weather on certain days and these various signals that are used by quantitative traders. I'm not saying there's anything wrong with it, but I don't think that even quantitative trading works unless there are a lot of people making fundamental investment decisions. We look for very high quality businesses, what we describe as simple, predictable, free cash flow generative, dominant businesses, a business that Warren Buffett would describe as having a moat around it, right? If you believe that the value of anything financial is the present value of the cash you can take out of it over its life, well, you need to know how much cash it's going to generate over its life. So business quality to us is the single most important criterion for determining what's interesting. Because if we can't predict the cash flows, we don't know what it's worth. If we don't know what it's worth, we can't invest. So we figure out what it's worth, figure out how good the business is, how predictable will this cash flows be from a railroad or a spirits company or a real estate company, shopping mall business. And then we say, okay, well, where's it trading? And if there's a wide gap between price and value, you can buy it for 50 cents, it's worth $1.20. Well, then we're going to take a hard look and try to understand why it trades at a deep discount. And once we understand the reasons, we decide, well, these things that we can solve. Or can we, in light of the situation, the circumstances, can we be influential in changing these levers that can cause this valuation discrepancy to narrow? And is this a business that, while we're causing the valuation discrepancy to narrow, we can also perhaps contribute to the valuation growing? And if those things are true, we found something that looks quite interesting for us. A lot of people talk about risk in the stock market. It's the risk of stock prices moving up and down every day. We don't think that's the risk that you should be focused on. The risk you should be focused on is if you invest in a business, what are the chances that you're going to lose your money? That there's going to be a permanent loss. When you're thinking about investing your own money, when you're thinking about one investment versus another, don't worry so much about whether the price moves up and down a lot in the short term. What matters is, ultimately, will you get your money back? Will you earn a return on your investment? I hate to be boring on this. I do think Buffett is the greatest investor. And the reason why I believe that is, this is a 50-odd year, it's a 60-year track record of compounding at 20+% with a very modest amount of leverage, in the form of principally insurance float. And I just don't think there's a record that compares. And I also think that what he does actually creates value for the world. I think George Soros is an incredible investor, but I think what he does as an investor creates no value for the world. No, I think what he does as a philanthropist, I think he creates a lot of value. So I think Buffett has the benefit of, I think Heinz will be a much better business by the time, as a result of Buffett's ownership. You look at what he did with Geico since he bought it. I think he's created enormous, he's bought businesses well, but not incredibly well as he's gotten to be quite large, but he's made those businesses much more valuable. And I think he's also created a lot of messaging that's affected the way people think about executive compensation and derivatives. So I think he's made an enormous contribution. So I think it's a combination of long-term, kind of longitudinally, and the accomplishments he's had. So I think he's the best, by far the best.
Tell us a little about your portfolio. Why so few names? Obviously there has been some rumors of the performance up 6% for the first quarter. I know you can't say that's accurate or not accurate. With most of your portfolio up double digits, one down double digits, which we'll talk about. But give us just a take on why so few names and...
So for a bunch of reasons. I've always had the view that, why not own the best 10 or 11 investments as opposed to ideas 12 through 25 or 12 through 100, which is more typical. And, I think there are very few great investments at any one time. So the ability to concentrate is an enormously valuable asset of a strategy. The problem with it is it leads to bumpier returns. And it leads to more attention on mistakes or things that aren't going well. I don't know a portfolio manager that doesn't have a stock that's down in his portfolio, right? But you don't read articles about, we're getting an awful lot of attention for a pretty high profile situation that's struggling. But I think there's, it depends on what your business model is. But if you want to make high rates of return over a long period of time, it's hard to do that being very diversified. If you look through the Forbes 400, wealthiest people in the world, most of them made their fortune in one business or a portfolio of two businesses. Very few made it in a portfolio of 100. So it's that, and the other benefit, it allows you to run a much simpler investment firm. We have an 8-person investment team. If we had 30 names, we couldn't manage that portfolio the way we do with a small team. By having a small team, you can hire better talent.
Principles are basically, one, invest in simple, predictable, free cash flow generative, dominant companies with large barriers to entry that earn high returns on capital, that have limited exposure to extrinsic risk we can't control, strong balance sheets, don't need access to capital to survive, have excellent management, good governance. Sounds logical, but occasionally we've diverged, and there's those times, there's a certain discipline that comes with investments, and there always seems to be a countervailing quality that caused us to diverge. But in really each case where we've compromised on business quality or complexity, we've been harmed from an investment standpoint.
If you're going to be successful in your career, you're going to make some money. And how you invest that money It's going to make a big difference in the quality of life that you have and perhaps that your children have, or the kind of house you're able to buy, or the retirement that you're going to be able to enjoy. And we talked about the difference between a 10% return and a 15 and a 20% return over a very long lifetime, what impact that has in terms of how much wealth you create over the period. So investing is going to be important to you whether you like it or not. And learning more about investing is going to have a big impact on your quality of life. If money is something that you need in order to meet some of your goals. I got interested when I was probably 22 or 23. I started interested in being an investor, and I read a book. I read a book called The Intelligent Investor. It was written by Ben Graham, and Ben Graham is a famous value investor. And it's kind of like reading Jean-Paul Sartre's essays on existentialism. You read it, and it either is an epiphany and it affects the way you live your life, or it's of no interest to you. And this was the equivalent, but in investing. I found it fascinating. And what I liked about investing is it was something very accessible even to someone who's 22 or 23. What's kept me intrigued is that it's one of the few jobs where every day you can study something new. You're constantly learning about new businesses, new situations, new management teams, new issues. So it's infinitely challenging. And the world and the stock market are obviously very dynamic places, so the challenges continue. These same concepts, while they're useful in deciding how to invest your portfolio, they're also very useful to you in thinking about decisions like buying a home, making decisions in your line of work, whether to hire additional people. These kinds of calculations and thought processes are helpful, and they're helpful in life, and I recommend that you learn more. The vast majority of the capital markets today, the public capital markets, the investors are passive. They're indexed, they're closet indexed, they're index plus an alpha strategy. And if you look at the shareholder list of major companies, it's BlackRock, it's Fidelity, it's Cap Research, it's Vanguard, and by charter, these institutions are passive. If you think about capitalism, 100 years ago, it was very different, right? You had Carnegie, you had JP Morgan, you had players who'd buy big stakes in businesses. They were control shareholders. There was an owner on the board of directors. So capitalism over time has democratized, which I think is great for accessibility to the average man in terms of investing in the market. But you get rid of owners controlling companies. And I think what activists do is they represent other shareholders. If you think back to my friend Mr. Icahn in the 80s, he operated very differently. Today, an activist shareholder takes a stake in a business and is only successful if all of the shareholders benefit. It's not green mail where the activist investor buys a stake, gets a benefit for himself, and moves on. If you take a stake in Canadian Pacific Railroad and other people follow you in and they vote in your directors and a new CEO comes in and the stock does well, the shareholders benefit collectively. So I think it's a very valuable feature for the market. If the shareholders don't support the activists, it never gets done. And we're not a control investor. We're a lead investor. We're leading the charge on behalf of other shareholders.
There's actually an argument that some people are now making that, buying the index or buying diversified funds have had much better returns than buying, those hedge funds that have, a very specific smaller portfolio approach like yours.
I haven't seen that article. I mean, I think we've done very well relative to any index alternative, certainly. So it depends on how you judge us. I think if you judge us on a 90-day basis, I have no idea how we're going to do relative to an index. But I think this is a strategy that over time should earn a meaningful premium over, any kind of benchmark, or you shouldn't give us your money. I don't know. There are very few people. You look at the most successful people in the world. I know very few of them that haven't had a major failure. If you read through they're not the financially most successful people. If you read through the Forbes billionaire list and you read their stories, they've had failed businesses and they've lost everything and they've hung on they've almost died holding on to the ledge. What's his name? The guy on CBS and Sumner Redstone.
Redstone.
Yeah. So there are lots of examples of people who had huge adversity. And I think it's how you deal with adversity that determines your ultimate success, as opposed to how you deal with success that determines your ultimate success. So that's one of the things I've learned. Just be direct. My approach in business, in my personal life, in a management role, is extreme candor. And I think that if you live that way, you'll run the risk of offending various people over time. But you'll have much better relationships because, if you tell people the truth, first of all, it's not typical. A lot of people, in the interest of politeness or fear of confrontation, or it's just uncomfortable, don't speak the truth. And that goes for people on boards. There are lots of examples of super talented people sitting around the room as an institution is failing. Think of all the banks during the crisis where people were not willing to confront the CEO. So I'm willing to confront the CEO, but I'm completely candid with him about his successes and his failures. But I give him, I don't step on his, I don't run the company. I'm not involved day to day at all. I trust his judgment. It's a bit of a trust but verify type relationship, and it's worked very well. So that's my only public leadership role. I am CEO of Pershing Square. It's a much easier business to run than a normal company because we've got only 56 employees. And here the key to successful leadership is, one, hiring the right people. I have the benefit of not inheriting anyone because I hired everyone in the company. I interview every receptionist, I interview every secretary, I interview every investment person. And so I get to pick ultimately everyone that I work with, and that helps leadership a lot. Because if you hire, the key behind leadership, if you hire super talented people, you don't need to do that much leadership because they're going to do the right thing. Second thing is setting up the incentives correctly. So in Pershing Square, everyone is incentivized by how the overall firm does, which I think is a good dynamic because it creates teamwork. I follow the same extreme candor approach in evaluating people. And I care about everyone I work with as I do family members. And so we look out for each other, and if someone's going through a difficult health issue or personal issue, financial issue, or I have the benefit of having a lot of relationships, and whether it's the medical community or in the business community or in the political community, and so we help our people. And we don't tolerate insincerity. People are encouraged to admit their mistakes immediately before they figure out a solution to the problem. So when I hired my CFO, in the first year of working with him, he would approach me with a mistake he had made after he had figured out how to solve the problem. And I would get angry with him every time. I said, no, I don't want to hear about the mistake after you figured out the solution. I want to hear the mistake now, and then we can work together on solving the problem. So I think if you have an organization where people very quickly admit mistakes, and where you're candid with them, and they're not punished for making a mistake, that is a very good dynamic. And it's worked very well. We have almost no turnover, even in the reception desk at Pershing Square. And that's worked, it's been a good model. Great. And so I don't do that much leadership other than, I guess on the leadership side, I think you have to, you have to set an example in terms of the way you live, in terms of the way you behave, because that affects how other people will watch you. So my other key success factor for being a leader in the 21st century, in the era of everyone having a video camera on their cell phone, is assume that everything you're doing is being videoed and recorded at all times. And that will, and consider that the video ends up as a top video on YouTube, and then adjust your behavior accordingly.
Fair.